Hey, what's up guys? It's your boy Freddy. Welcome back to the channel. As many of you may know, the market has been in a bit of a rough patch these last few weeks, seeing some reversals after the crazy run we have been on, basically since right after the illness began. Many of you may be wondering if there are any undervalued Canadian dividend stocks that you should be looking into during these dips. And today I want to go over 3 Canadian stocks that I'm considering adding to my WealthSimple dividend portfolio. For 2021, I have set a goal for myself to get this portfolio to produce an average of $50 per month in dividends. Right now, if I change nothing about the portfolio and just let it do its thing, I would expect around $14 per month in dividends. And of course, this isn't a consistent $14 per month where I'd see like 14 in January, 14 in February. It's more of like a bulk payment that I can expect like every once in a while. For example, maybe like 10 in March, 30 in April if there's like earnings, and then maybe like 15 in May or something like that. So clearly I do have quite a bit of a mountain in front of me to try to get this account to produce that $50 goal. And for a so-called dividend account, my account is a bit on the low end at around a 1.7% yield across all of my positions. And this is because during the year of 2020, I was experimenting with various different styles of investing on WealthSimple and looking at all the tools that it had to offer. I did land on dividend investing, or more specifically Canadian dividend investing, for a couple of reasons. One being that on WealthSimple, I won't be charged a commission for these Canadian stocks. And this is a really powerful tool because that means I can dollar cost average to a very extreme extent and take advantage of these red days in the market. As Canada's only commission-free trading option at the moment, I think it's absolutely necessary to take advantage of these opportunities and use the tools that we do have available. Another reason that I'm choosing Canadian stocks is that I won't be charged the 1.5% conversion fee that's usually associated with US stocks. So this does mean that I will have to retool the portfolio slightly. I won't be selling out of my growth plays or my US plays. I'll simply have this new goal in mind from now on. If you guys are interested in taking a look at my current portfolio and how much that portfolio pays me in dividends, I will have a link to it in the description down below. The 3 Canadian dividend stocks that I'm going to go over today are all going to be great buys in my opinion. They're all fundamentally strong companies and their dividends are growing at an amazing rate. But of course, do your own research as well before getting into any of these plays. Jumping right into it, at number 1, we have Algonquin Power and Utilities. And like the name suggests, they are in the business of generating, transmitting, and distributing utilities. They deal mostly with water, natural gas, and electricity distribution for many US states. And what I really like about the company is their method of generating this electricity. So they create their energy through hydroelectric, wind, solar, and thermal power plants. I'm a really big fan of these future and green styles of and renewable styles of energy generation. And I believe that this company can become one of the biggest names in energy creation here in Canada and basically all of North America. Even before this market dip, this company was seeing weakness as a direct result of the weather situation that we saw in Texas. Because of the freezing temperatures and the crazy storms, the $300 million wind farm that they purchased back in 2020 saw over $55 million in damages. The company said that these damages would result in around a 5 or 6% drop to their earnings compared to their 2019 values. And looking at the stock price, you can see it's down almost 13%, which shows that it is an overreaction. Looking at the dividend growth rate, we can see that the company's dividend is growing at an absolutely phenomenal rate. Over the last 5 years, it's seen almost 10% on average growth, which is really quite amazing. I have been looking for a power and utility stock for a while now, and I feel like this company is the one that I'm going to be going with because of their push towards green energy, and I think I'll be beginning to build out a position over the next few months. At number 2, we have Financial Corp. This company works in the finance and insurance space, and they're a very established position here in Canada as they have been in business for well over 100 years. They have quite a few revenue sources, including individual insurance and wealth management, company insurance and employee plans, as well as group savings and retirement plans. So they are a well-rounded company that is a very safe investment in my opinion because of how large and established they are. Looking at the stock history, we can see that they are on their way back to their pre-pandemic levels and they still have a lot of upside to get back there. Furthermore, their price to earnings ratio is 11.5, which shows just how undervalued they truly are. Their dividend growth rate is also absolutely amazing. Over the last 5 years, it has grown on average 11%. And on top of all of that, they have a payout ratio of 34% and has consistently been staying at that level for more than 10 years. Right now, the only exposure I have to finance is Bank of Nova Scotia, and I have no exposure whatsoever to insurance. So this is one stock that I'm definitely considering adding to the portfolio because of the growth rate that I do see for the stock price. And the fact that the dividend has been growing for such a long time and for so many years definitely gives me a lot of confidence in this company and makes me think that I should use it as my exposure to the insurance industry. At number 3, we have Telus. This is one of the 3 big telecommunication giants that we have here in Canada. They have quite a few revenue streams, including wireless, internet, TV, home phone, and security. What I really like about the company is the security side of their business. The fact that if you already have your mobile through them, it does make sense to simply get your internet as well as your TV through them as well. And then if you are looking to get security, it would also make sense to get your security through them as well, so you have a seamless and integrated system. This integration in the various aspects of your home gives me a lot of confidence in the company. Most of the other telecommunication companies aren't innovating in the way that Telus is, and it makes me believe that they will become the major player and increase their market share in the coming years. The stock is down about 7% over the last month, and in my opinion, it's definitely a good opportunity to dollar cost average into the company. Their dividend yield is also very solid at almost 5%, and it has been growing at an average of 9% over the last 10 years. Like you guys saw in my portfolio breakdown, I do have a small position in this company already, and I have been dollar cost averaging in over the last week or so, and I will continue to add a bit more heavily if the stock continues to drop. Well, that is my list for the 3 Canadian dividend stocks that I'm looking to buy in this market correction. Let me know in the comments down below what you guys have been buying. Also remember to hit that like button, as it really does help the channel to grow, and consider subscribing for more investing videos like this to come. And I also have a WealthSimple referral link in the description that gives you $10 when you deposit and trade with 100 or more, which is an instant 10% return on your money. I'll catch you guys in the next one.